gavel and galley. This is the CalABLE Act Board. Today is Tuesday, May 19th. We are meeting at 915 Capitol Mall. Conference room 587 in Sacramento. All right, so who's going to read the phone script? Ann?
For those of you joining us via phone, welcome. You are currently in listen-only mode. If at any time you are disconnected from the conference call and wish to rejoin, please redial and enter the same participant code. During public comments period, if you wish to make a comment, please press 1 and then 0. We will first hear from the attendees joining us in person, and then from callers, taken in the order they joined the queue to speak. You will hear a message when it is your turn. Once you are done speaking, you will be put back into listen-only mode.
Thank you. Okay, Ann, can you please call the roll?
Fiona Ma,
Here.
Betty T. Ying,
Dave Oppenheim for State Controller Betty Yee.
Keely Martin Bosler,
Is the phone on?
it's on.
Just, okay.
I didn't hear her
I didn't.
dial in, but just remind folks if they muted themselves.
If anyone is on the phone, as far as the board members, if you have muted yourself, can you please unmute yourself for roll call? Keely Martin Bosler, Maria Marquez, Joe Xavier,
Elena Gomez for Director Xavier.
Nancy Bergman,
John Doyle for Executive Director Nancy Barshman.
and Peter Mendoza,
Do we have quorum? No. How many do we need? 1, 2, 3, 4.
Somebody dialed in, I'm not sure.
Seven, we have 4 people, so 7 members.
2, 3, 4.
We've got one.
7. Okay, we have a quorum. All right, let's move on to action item approval of the meeting minutes from February 25th and March 2nd for the CalABLE Act Board. Any comments from members? The public? Anyone on the phone? What is that other phone yet?
this one?
Yeah. Are there
This is
two?
for this one. This is the public line, and this is for
Oh.
our presenters.
Okay. Fancy. We have 2 lines now. All right. Any comments? No? Do I have a motion?
This Elena Gomez, I move to approve the meeting minutes from the February 25th, 2020 and the March 2nd, 2020 CalABLE Act meeting.
Thank you. Do I have a second?
I'll second.
Okay, we have a motion and a second. Ann, please call the roll.
Fiona Ma,
Aye.
David Oppenheim,
Aye.
Gail Miller, Sandra Aldana, Elena Gomez,
Aye.
John Doyle,
Aye.
Jacqueline Jackson,
Okay, the minutes have been approved. Item number 2, Executive Director's Report. This is an informational item.
Good afternoon.
Just a quick question, do we have a quorum?
We do.
Okay.
can we take one moment? I disconnected the public line. I need to redial
Oh,
it.
okay.
I can go check, because I was expecting other board members on the line, so I'm going to go check my email if that's okay.
Okay.
Hi, good afternoon, everyone. This is Sandra Aldana. I'm sorry, I saw the vote and I literally just missed it.
No problem. Just We're on a little break right now, but just hang on for a second. Thank you, Sandra.
We're good.
Yeah, thank you.
Sandra just added.
Okay.
Anybody else?
Andrea was calling in, not a board member, but a presenter.
Oh, okay. Andrea on right now?
I just gave her the full information.
Okay. All right, so why don't we continue with your executive director's report?
Thank you. Good afternoon, everyone. Wanted to touch on a few things, and first and foremost, and I'm sure what's heavily on your mind is how things have changed for the program over the last few weeks. I typically start these presentations with information regarding the weekly statistics that we receive, and that's a great barometer to let you know where we are. As of yesterday, we are just under 29 or 3,900 enrollments. We average about 50 new accounts opened each week. We did see right around the middle of March, we saw a slight downtick in weekly enrollments. I think the lowest that we experienced was 34 enrollments for a single week. I attribute much of that to the fact that we had a number of outreach events that were scheduled and in the works, that as soon as the stay-at-home orders started coming out, those all went away. We went through a period, a couple of weeks where we saw enrollments in the 30s and 40s. And over the last week, we're actually seeing higher than our average enrollment. So we're, I think we had in the 60s last week, the 70s the week before, and we were 59 as of this current week. And so that slight downtick has turned into what I would consider a slight uptick. So lots to be encouraged by. In addition to our in-person enrollment events going away, we've actually seen now requests are steadily coming in for virtual events. And we've held a number of webinars and virtual events. We actually have another one coming up in June where we'll launch a new program, but it's pretty exciting to see. In your materials, we have our most recent outreach report that talks about these virtual events, and what you can see is that we get a substantial audience for these events, and I think that we can at least attribute some of that uptick in enrollment to the fact that we're out there. In addition, we also shifted our focus a little bit since our outreach events freed us up from a time perspective, and we focused on a couple of things. One was bolstering our social media outreach, and so we have developed a pretty extensive calendar that puts us out in the community, in our social media communities on a regular basis. And we also expanded our earned media opportunities, and those are where we look for news stories, things that we don't pay for but have to go out and actually pitch and earn. And so we partnered with the State Treasurer's Office Communications team and had a couple of news articles published over the last few weeks. One of them in specific is something that we'll focus on for the near term, and that's looking at SSI recipients who are receiving stimulus checks. As you're familiar with the COVID-19 crisis, individuals have been receiving stimulus checks of $1,200 per adult and an additional $500 for qualified minors. And the great news about this is that it was SSI recipients were included on that. There is some potential jeopardy for SSI recipients in that if they hold on to that money for a year or longer, it begins to count against their resource limit, the amount of money that they can have in assets. And so we've actively gone to communicate to folks that if you need the money now, if you need to use the money now, do so. If you're going to hold on to it, a good protection for you is to put it into a CalABLE account. And therefore you would, anything below that $100,000 threshold is not counted against you as an asset. And so that's been a good boost for us to tell a story in a very crowded mediascape and crowded by the coronavirus. And so in order to get stories out about CalABLE during this time, we've had a good opportunity. I was also featured in a report, a profile report in the Keeping Up reports for the Capital Morning Report. And so it was a good opportunity to talk about the program and some of the benefits of being a part of it. So those are just some of the ways that we have extended our outreach. Since our last meeting, there were a couple of contractual things that I wanted to let you know of. We did initiate our extended contract with Sagent Marketing, and they've been a great partner with us in developing the social media calendar, and really making it robust and pointing to the elements of the program that appeal to our various audiences. We did put a pause on our strategic planning work. We were hoping that by this board meeting, we would have a deliverable to share with the board. And the reality is that during a crisis is not the time that you look forward to the next 3 to 5 years. We're really trying to figure out what the next 3 to 5 months will look like. There is some hope, though, that by our fall meeting that we'll have an opportunity to have picked that back up and at least have some progress to share with you by then. I mentioned at our last board meeting that the treasurer has taken on an official role in NAST as the chairperson for the ABLE committee. NAST is the National Association of State Treasurers. There are a couple of developments in that. We moved the annual NAST conference to be a virtual conference, and so we'll be hosting in June and July each week. On Thursdays, we'll be hosting a webinar that is designed to educate our fellow ABLE committee peers, as well as community members on the benefits of the ABLE program and some of the more intricate facets of these ABLE programs and how to improve as an industry where we're going with that. We also have a partnership with the National Association of State Councils for Developmental Disabilities, and that is more fuel around this, the stimulus payments and SSI recipients. So we have partnered to jointly develop some printed materials that can be tailored for each of the states that participate in NAST and work with their individual state councils in order to deliver, to be a delivery mechanism for that communication. And so we have begun reaching out to the ARC of California and the State Council, our State Council for Developmental Disabilities, to share those messages. And then finally, we discussed as a group a potential opportunity for CalABLE to have another state join in their own, Connecticut, and their own state-branded version of CalABLE. We submitted a proposal. We went very far into that proposal process and participated in interviews with the state of Connecticut, and we were informed last week that they've gone with another state. They haven't publicly announced who that other state is, so I can't give you any information yet on what were the defining elements of that. I can say that it was a really good exercise for us. And I can also say that based on the level of questions and the conversations that we had with Connecticut, we feel really strongly that we were a heavy consideration and it wasn't just a courtesy call. So I will continue to look for potential opportunities that will either bolster our program through additional enrollment or whatever the opportunity may be. Those are things that I will continue to explore. I mentioned the changes in our outreach. I should also mention, also in your packet is the CalABLE Quarterly. That's a newsletter that the CalABLE staff publishes, and it goes out to our stakeholders, and I make sure that each of you are included in the, is it not in the?
I don't think,
Didn't
but
make-
we'll get
didn't make-
it.
We'll get it to you. But it's something that we will continue to distribute. And this particular issue focused on it was sent out right at the beginning of April, so it was focused on the changes in the marketplace. We did receive a number of calls towards the end of March and the beginning of April where folks were concerned and they were saying that they were losing money and how could they potentially address that. As you are fully aware, we are not advisors, and so we don't provide any financial advice, but there is opportunity to educate, and so one of the things that we wanted to make sure of, that folks were aware of, is that if they were moving their money or pulling it out, they would be participating in what could potentially be a low point in the market and not be participating at all if the market were to recover, as it has in some ways, even though we haven't seen a full reversal of the losses that were in the beginning of this crisis. We have seen some recovery. So, additionally, we talked about a partnership that I entered into with the California Department of Social Services. And this was specifically looking at a large mailing somewhere in the neighborhood of 300,000 ABLE eligible SSI recipients in the state of California, and that we had run into a snag. And that was with the Social Security Administration, and they had issued a denial to CDSS for access to the database to actually complete that mailing. And so we partnered with CDSS to appeal that ruling, and we found out again that they denied our appeal. We continue to look for opportunities with CDSS. The great thing about this is we didn't, well, the bad thing is that we missed what is a very valuable opportunity to be able to communicate directly with people who could benefit from a CalABLE account. The silver lining in all of that was we didn't lose anything. There was not a major investment that we had to put in to get ready for this. And so we're continuing to look for opportunities both to partner with CDSS and to get access to that database from the Social Security Administration to be able to do a mailing because something that size to an audience that directly fits and would directly benefit from CalABLE is too good to pass up if there still is an opportunity there. The last thing I'll say is that we will have another webinar in June. It's June 14th, 17th, and it will be the official launch of a new program that we have, and it's the CalABLE Ambassador Program. And so we are seeking CalABLE account holders and their authorized legal representatives who are willing to share their stories, both in their own networks and through our larger outreach. And so this webinar will talk about, we'll give a basic primer on CalABLE and how the program works, but we'll also talk to those folks about submitting an application. This is something that we will actually screen folks to make sure that they are fully prepared to tell their stories, and we'll put them to work for the benefit of the program, especially those who have great stories. And we're actually looking for if folks have achieved a goal or they have a goal in mind and they're moving things towards that goal. We'll communicate with those folks and see if they can come on as ambassadors. The last thing that I'll talk about is that we have been down a staff member for an extended period, and I'm happy to say that we have extended an offer and had that offer accepted from Sandra Kent. And Sandra is already a State Treasurer's Office employee with CDF. And she is, I don't know if this is the right terminology, but she's the reigning State Treasurer's Office Employee of the Year. And so we are very, very happy to have Sandra joining us. She's listening on the phone today. And I'm sure that you will see the great things that she will bring to the program. I also want to thank Susan Block. Susan is a retired annuitant, and she has been with us and will continue to be with us for some additional time, but she has stepped in and handily worked with all of you individually and with us as a team to make sure that these meetings have run very smoothly, and we really appreciate her work, and she still is going to help us out by being a contributor in the training of Sandra to get her up and ready as our new program analyst.
Great.
Definitely deserves an applause. We're very happy to have her. Unless there are questions, that is it for my ED.
Yes, thank you very much. I just posted your Capital Morning Report on Twitter. Thank you for reminding me. Private sector, just wondering if you're able to partner with some of our utility companies. I know, SMUD sends out notices, or PG&E perhaps. Maybe that's a way that we can do a little bit more outreach. Bus shelters, maybe eventually we'll get back to riding the bus again, but I know a lot of these companies also have space available for nonprofits or government run programs. And Sandra Kent, congratulations. You know, she loves getting her picture taken. Okay, so anytime you have an opportunity to, you know, put her on a PSA or tag her on social media, I definitely would highly suggest it. And I know she can't speak, so I know I'm getting her back, Sandra.
Thank you.
And I do think Gail is on the phone too. Gail? Have you joined us?
Yes, Gail is on, can you hear me now?
Okay, yes we can. Thank you.
And so just a little bit of feedback to your first request about partnering with private organizations, and that's actually an initiative that we're taking on with NAS to develop essentially a playbook on working with independent partners to communicate ABLE, and we're looking at a number of avenues. First is working with organizations to tap into their employee bases, and then once we're inside these organizations to really tap into their customer bases. So we look at that as a great opportunity and something that we will be exploring in great detail in the future.
Yeah.
Yes? Gail?
Just a quick comment. I just really wanted to commend Treasurer and Dante and your staff for taking the quick and strategic opportunity to do outreach around the stimulus check, because that is so much on everybody's mind. And during these difficult economic times, to focus on that and get outreach on that, I think was just very commendable on your part and Madam Treasurer, to get a message out there that might not ordinarily be heard as much as it was.
Thank you. I think that thanks, I would like to extend that to the communications team, because they were right on top of it. As soon as we reached out to them, they were ready with pitches and press releases, and we're actually in the development stage of an op-ed too.
Great, yeah. And I would like to add, you know, this June 17th webinar coming up, let's do a little bit of media around some of these ambassadors.
Yeah.
So I think that would be a really good way to highlight the program. Elena?
Okay. Thank you. Thank you for that acknowledgement about the federal stimulus check. I think, you know, credit to the team for pursuing that opportunity. Just two quick questions. First, it's just for the benefit of the public. Could you clarify what was the basis of the appeal for not being able to access the database with the Department of Social Services? And secondly, and I've lost track of this particular legislation about increasing the age eligibility for the ABLE Act, and I'm not quite sure what that is. I think it would be beneficial to get an update on that as well.
Going to your first issue, the Social Security Administration denied the Department of Social Services request to access the database because they interpreted what we were doing as essentially a marketing function and not one of the core functions of the supplemental security income. And so while we agreed that it did have a somewhat of a marketing component, we disagreed in that it wasn't a benefit to any private entity that was merely solicitous, and that it was a benefit to SSI recipients that could propel them into a better financial position. And so one of the potential remedies to this is that we are looking to submit an additional request that will come directly from CalABLE instead of going through the Department of Social Services for the future. And that may be enough of a solution. I'm not sure at this time, but therein at least lies an additional opportunity. The second issue that is looking at the Able Age Adjustment Act. As you may imagine, Congress has its hands pretty well tied these days, and so there hasn't been any additional motion on the attempt to raise the age of eligibility or the age of onset for disability for ABLE eligibility from 26 to 46. Again, it's estimated that an additional 6 million people nationwide would be eligible if that change was made. But we are looking for opportunities to build that into a lot of our outreach and communication about CalABLE, including some opportunities for folks to be educated upon about the legislation and then directly email their elected representatives from our CalABLE website if they so choose.
Thank you.
Great. Any other board members?
Hi, Dante. This is Sandra with the State Council.
Hi, Sandra.
Hi, Sandra.
You can hear me.
Yes, we
hear you.
can.
We can hear you.
Okay, great. There is a little bit of delay on the phone, so I do apologize. I do have a quick question. Last time we talked about trying to do a mailing through Social Security, and that they had denied the mailing for the same reason it sounds like the Department of Social Services did, which was the privacy issue. My question again is if these entities are just mailing out information that we have put together, what is their argument for refusing to mail our information out to their recipients?
So we did actually climb a number of hurdles to get to our final denial. And one of those was related to privacy, and it was determined that this wouldn't be a privacy issue because we were not accessing the database, we weren't possessing the database, we were simply providing a postcard that would have information that was being mailed directly from a clearinghouse. So the issue was more along the marketing. I guess there are what they consider, and I hate to use this word because we use it in a very different context these days, but an essential function of communication to SSI recipients would be something that was directly related to their receipt of SSI benefits. And so since CalABLE is not a direct benefit of SSI, they interpreted it as more of a marketing function.
I'm sorry, that just doesn't make any sense to me.
Yeah.
CalABLE is a federal law that entitles SSI recipients to get one of these accounts to protect their finances, to be able to use them specifically for disability-related expenses. So I'm kind of confused as to why both entities have taken the same. They're both state entities, correct?
No.
Social
That's
Security is federal, right?
yeah. So the
But
social.
then they're both government entities, is what I mean. I'm kind of really confused as to how they think not informing recipients of valued services about additional valued services that they would qualify for is not essential to their role and responsibility. I don't know how that works. I'm just kind of confused to why are they chalking it up to marketing as opposed to, when I get stuff from Medicaid, I get stuff about Social Security all the time, right? So other state entities and federal entities are letting each other know about other programs that individuals receiving their services may qualify for. Why are they considering ABLE to be different if it's written into federal and state law?
Yeah. I think you raise very good questions, Sandra. The thing that I want to be completely clear about is that the California Department of Social Services are very much in lockstep with our view, which is yours, that this is not to be taken or excused lightly as some marketing effort might be from a for-profit company that had something to gain from such a mailing, but that this is of great benefit both for the federal government and for the residents of California, for communities to be aware of such a program. And so we haven't given up. I think that's the core message, is that we will continue to pursue this until it becomes abundantly clear, unless and until it becomes abundantly clear that we will not be fruitful in our efforts.
And then, do we have a relationship, I'm sorry, this is just follow-up questions, I apologize. Do we have a relationship with DDS, and would DDS be willing to do mailings of that nature for us?
We do have a relationship with DDS, and they're on the board and on the phone. So, John, we haven't talked specifically about this kind of mailing, but I'm happy to explore that for the future.
Yeah, Dante, this is John Doyle. I agree. I think that it's something we could take a look at, and to the extent the department could provide assistance, I think we'd be happy to at least see what's possible.
John, can we pause you? We have a phone issue here. I don't know why the phone is ringing. So.
This is Robert with 2020 Healthcare Central.
Okay.
Cold call.
Okay, finish your thought.
Are you on?
No, I have to redial in. So I'm gonna wait till you're done. Are you done, John?
Sandra?
Yes, that's it. Thank you.
Are you still there, Sandra?
Yeah,
Yeah.
I'm still here.
Okay. Do you want to continue?
Sorry, I was muted.
No problem. Do you have anything else that you wanted to, or did we fully answer your question?
No, you fully answered all my questions. Thank you so much.
Thank you.
Any other board members? Okay, this was an informational item, so thank you, Dante. And since we have Gail and Sandra on the phone, can we open up the minutes so that they could vote
Sure.
officially on the minutes?
Okay. Let me see. Keely Martin Bowsler for the minutes.
Gail Miller for Keely Butler, aye.
And Maria Marquez, Sandra Aldana.
Sandra Aldana for the State Council on Developmental Disabilities, aye.
All right.
Thank you.
Thank you for adding on. All right, let's move on to item number 3, review, analysis, and performance monitoring of investment portfolios for CalABLE for quarter number 1, 2020. This is an informational item, and we have TIAA and Makita.
Thanks. Before I turn it over to our partners at TIA and Makita, just wanted to again touch base with you all. I indicated previously, and will continue to reiterate this, that when I look at our quarterly performance, I'm looking at it with a very critical eye. One of the main things that I'm looking at is if there are any glaring things that say the board may need to take action on in a short-term basis. I previously mentioned that I'm keeping a very close eye on the performance of our FDIC insured portfolio. One of the things that I'm looking at, and it is in direct relation to a board action that has already been taken, which was to waive the state administrative fee for folks who select that option. And part of the rationale that we provided when you as a board made that decision was an estimate that about 1/3 of CalABLE account holders would choose to place money in that particular portfolio, or at least about 1/3 of the assets would be placed within that portfolio. And so as you will see in this report, we still hover right around there. We're at the 35% mark now. And I can say that this is as of Q1, and I can say that Linda has been Sally on the spot in providing me with an even more timely look to say within the last few days and weeks of where we are, and I can say that there's been no major shift, even with the crisis having some time to weigh into people's thoughts and minds, and as a reflection of their financial investments. So with that, I can turn it over to Glenn to give us an investment report.
Before we start with Glenn, somehow we have gotten disconnected from the public line, so we're going to try again. So be just one moment here.
Number you have.
Welcome to AT&T's teleconference service. Please enter your access code, followed by the pound sign. To join the conference as the host, press star. Otherwise, please enter your host password. There are 1 participants on the call, including you. You are joining your conference as the host. For a menu of available commands, press star pound.
Okay, Glenn, we are ready.
Okay, thank you very much. Good afternoon. It's nice to join you all by phone. Because obviously the big news of the capital markets, but also just sort of the world in general, has been the COVID-19 pandemic. And I remember we started talking about this at the last board meeting back in early March, I believe, because it's had such wide-ranging effects. First, from a health perspective, that the health crisis that it caused, and the various efforts from around the country to contain the virus. But it's also had devastating effects on the U.S. economy. For example, there have been record levels of unemployment, and people are forced to stay home. Essentially, manufacturing has come to a standstill, and many experts now believe that we are currently in a recessionary period. It's had an effect on both monetary and fiscal policy. As I think a lot of you know, the Fed took swift action and reinstated a zero interest rate policy, cutting the Fed funds target rate from a range of 0.0% to 0.25%, which is similar to what it was right around the time of the global financial crisis. They've also introduced other liquidity measures that have been welcomed, and they've remained committed to doing everything that it can to keep everything afloat. I think you just heard from Dante before that several stimulus bills were also passed, and that was in an effort to assist businesses and to help revive the country. At this point, states are individually making decisions on when to reopen their economies based on the metrics that they've set. for example, like new confirmed cases or hospitalization rates. And they're determining how quickly and for what parts of the state actually reopen. And it will be a gradual process. In terms of the capital market, if you turn to slide 2 of the deck, which is also page 17 of the PDF, if you're following there, you can see that there's been essentially a severe downturn in the markets, which again we started talking about at the last meeting, and it's been extremely broad-based. You can see from this slide there have been large double-digit returns from essentially every major equity asset class, from growth to value, large cap, small cap stocks, international developed stocks, emerging market stocks, pretty much across the board. Bonds, on the other hand, did quite well because as people sold their equity positions, they bought into safer investments like fixed income, which bid up bond prices. So there have actually been positive returns for bonds that are highly rated, like treasuries. Are there any questions on the kind of macro picture? Okay, I will move forward to slide 3, where, as I kind of always do, I'll just review the 4 portfolios that participants have to choose from when they are opening a CalABLE account. First, there is the FDIC insured portfolio. That's the bank account option. Then there's the aggressive growth portfolio, the moderate portfolio, and the conservative portfolio. At the end of the first quarter, assets in the program stood at just about $17.3 million. And as Dante had said, right about 36% of that was in that FDIC insured portfolio. And then the balance was split pretty much right evenly between the other 3 investment options. I'll skip ahead to slide 5, where I can we'll look at the individual returns for all of those portfolios. 3 out of 4 investment portfolios had negative absolute returns in the first quarter. And I'll just go from left to right. If you're looking at the top of the page with the bar chart, the conservative portfolio returns negative 3%. The moderate portfolio returns negative 9.9%. The aggressive growth portfolio returns negative 16.9%. And the FDIC insured portfolio eked out a small gain of just about 0.1%. And this is exactly in line with expectations, given everything that has been going on in the capital markets and what we would expect from the return streams from all of these portfolios. Moving to slide 6, just some additional details for anyone who wants to view this, to view a little bit more detail. You can see how the returns stacked up on a month-to-month basis. You can see that January overall was actually not such a terrible month. However, it was really February and March when we saw that severe downturn and where most of the negative returns are attributed to. Since inception, however, all investment options still have positive returns since inception of the CalABLE program. And then I'll move to slide 7, which is where I'll end my formal comments, see if there's any questions afterwards. But you can take a look at all of the asset allocations, the fees, and the performance for those options. Again, all of those underlying funds are included in those 4 investment options. You can see all of those allocations and how they're distributed. We continue to have a favorable view on all of the underlying funds that are used in the program. And just a couple other notes. If you look at the right-hand side of the page, the FDIC-insured CIA bank account is the underlying fund for that FDIC-insured portfolio. That's where most of the assets are, and again, that was the one portfolio that had positive returns for the quarter. The other thing I wanted to mention just briefly is that the funds directly next to that, the TC Life funding agreement, That has allocations in both the conservative portfolio and the moderate portfolio. And that investment is, I think many of you are aware, is more of an insurance product that guarantees a minimum crediting rate of return. The annualized yield for that product is currently 1.75%, which is actually higher than every maturity along the Treasury yield curve. So it's a very attractive yield in this current low rate environment. So that's helping buoy the portfolio in these severe downturns. And then I also, before I finish, I wanted to end on some positive news. And the positive news is basically the update about essentially what's happened since the end of the first quarter. April was actually a very strong month. It was actually one of the strongest months on record for the U.S. stock market. While the first quarter as a whole was particularly challenging in many respects, the equity markets had a really nice comeback in April. They've not recouped all of the losses that we've seen since the beginning of the pandemic, but it was encouraging. And I think part of it is that we now know a little bit more about the virus itself, and there's been increased testing, and the narrative has shifted from containment efforts to just reopening economies and kind of getting on the other side of it. So hopefully we've turned the page on the health crisis front, now that we've heard optimism surrounding possible vaccines. And from a financial standpoint, I think markets remain cautiously optimistic. They're still fragile. They will likely react to day-to-day news as we've seen them do just sporadically. But like I say, I think everything still remains very cautiously optimistic. So with that, I will pause and see if there are any questions or comments.
I do have a question. On page 7, how come the asset allocations don't equal to 100% in the funds? Or how do the numbers tick and tie?
If you sum the rows, essentially everything in the conservative portfolio should sum to 100%.
Oh, okay. Oh, I see.
Yes.
Got it. Thank you. Any other
problem.
questions from board members?
Hi, Glenn.
Okay. Is that Gail?
Sounded like Sandra.
Sandra?
Hi, Glenn. This is Sandra with the State Council. I have a quick question about page number 5. As I'm looking at the negative numbers, those are quarterly numbers, correct?
That's correct.
So does that mean that anyone who had any level of plan was in the negative for the first quarter, but it's now looking like they're bouncing back? What does that mean for our account holders?
Yeah, so what this is saying is that if you were invested in any one of these first 3 portfolios listed on this page, the conservative portfolio, the moderate portfolio, or the aggressive growth portfolio, if you were invested for the entire quarter, though that is the performance that you received. That is the return of your portfolio. So yes, it was a negative quarter as expected. Like I said, the FDIC insured portfolio did have a slight gain, and that's where most of the assets in the CalABLE program are. So a large portion of our participants actually did see at least some level of stability from that investment.
Okay. Great. Thank you.
Sure.
Oh, thank you. Excuse me. This is Dave from the State Controller. Again, on page 5, one thing I'm very heartened by is how our portfolio seems to be tracking very closely to the benchmark. So clearly the funds are definitely in line. The question I would have is on the way back up, since the best information you have we tracked the same on the upside as we did on the downside with our benchmark?
Yeah, that's a good question because, as you know, volatility is what actually creates some dispersion versus a benchmark sometimes because, like I've said in the past, a lot of these underlying funds are index funds, which is to say that they have an objective of tracking their benchmark growth of fees. So their objective is to track as closely as they can with those benchmarks. On the way up, I wouldn't say there's necessarily something about the direction that would affect whether or not they track closely to their benchmark. I'd say any kind of dispersion or variance versus a benchmark might be caused in terms of international equities, it might be caused from a fair value pricing process that the funds go through each night. Other than that, it could be just small dips or valleys in volatility. That might cause a discrepancy as well. So in terms of how it's been tracking so far, it's been pretty much right in line with expectations. I can tell you so far, nothing has stood out as an outlier as to say this underlying fund is not doing its job or it's not, abiding by its objectives. So everything is still maintaining that close level of tracking that we look for.
Okay, thank you.
Any other board members? Questions? Okay, why don't we move on to the other presentation?
Eric, are you on the line?
Yes, this is Eric White Makita. Can everyone hear me okay?
We can, Eric.
Okay, thank you.
We're still bringing your deck up for folks that are in the room.
Okay, perfect. You can go to, page 16 of that report when it comes up to, which is page 40 in the combined report for anyone using that.
What page is it?
16.
Page 50.
Got it. All right.
Okay, Tia already did a nice job kind of laying out the economic impact and market situation in the first quarter. So I wasn't going to spend a lot of time on that, but instead kind of focus my time on the performance of the actual plan in regards to how we monitor it, and then also in regards to its overall performance. In terms of very brief comments on the economy, I think the issue we've been dealing with at Makita the most. Sorry, was there a question or is that just feedback?
Nope, just feedback.
Okay, I apologize. The issue we've been dealing with at Makita the most is trying to kind of wrap around the concept of this disconnect between what's happening in the real economy and then what's happening in the financial market. So, as we all know, the global economy has, by intention, completely shut down, contracted enormously in the second half of the first quarter, and then will likely be that way throughout much of this, in the first quarter, and then throughout much of the second quarter. That is obviously having a huge impact on GDP figures as well as unemployment. And so we have actually probably the most bleak economic current situation as any of us will actually hopefully ever see in our entire lives in terms of GDP contraction as well as increases in unemployment. Unemployment is basically going to go higher than at any point other than the Great Depression, and it's going to do that over a time period that is truly unprecedented. It's going to do it in a matter of 4 to 5 months, whereas even during the Great Depression, that was over the course of many years. Likewise, GDP is likely going to contract by up to 20%, unheard of in terms of GDP contraction. But again, that's all by design. We're basically implementing steps to contract GDP by social distancing. That's what that entails. So, not surprisingly, GDP economic stats have been very poor. But in light of that, the stock market has actually done really well. Not just the stock market, all risk assets have actually done really well since the Fed has stepped in, and then the federal government has also stepped in to provide stimulus to that. So initially, the stock market sold off by 35%, the steepest decline in history. It did that decline in 24 days, which normally a bear market takes a full year to realize that level of loss. But since then, we've recouped a good deal of it, and year to date, the market's off only about 8%. So kind of keep that in mind when we start to go through the different figures later in this report, because as Glenn mentioned, April has been very strong, and then May has been pretty good as well. So looking at page 16 of the report, page 40 in the overall report, you can see the summary of the plan relative to our monitoring guidelines is very good. All funds are currently in positive territory, except for the inflation-linked bond fund, which is unacceptable. And our judgment that acceptable is exactly what it means. It's acceptable. It's not a bad thing. And so, from our standpoint, this is a very positive monitoring report. The other thing I wanted to kind of mention on this slide, just because it's how I kind of think about the overall plan, is if you look at kind of the underlying fund allocation for the entire program, you can see that in the bottom part of the chart, and you kind of do a back of the envelope analysis. And this should be taken with a grain of salt, and I'm just providing it because this is how I kind of, in general thoughts, think about the program, is if you kind of add up the underlying funds and think about performance of the risk assets and the safe assets and kind of blend those together, you can pretty much assume for the overall program that it has about a 25% sensitivity to the overall stock market. So if you're trying to think about how the plan as a whole is doing when the market is either selling off or going up dramatically, think of it as having about a 25% exposure to that movement. So if the overall stock market falls 10%, the plan as a whole will likely see its assets fall by about 2.5%. So I just want to provide that because that's how I kind of think about the program as a whole, and I just felt like I should share that since we're going through a time of rapid movements in the stock market up and down, and sometimes it's hard to get a sense of what the plan level exposure is to risk assets. So I will ask if there's any questions there, and then I'll move on to the next few slides.
Any questions from board members? Anyone? No? All right, let's
Okay.
keep moving. Thank you.
Hearing none, I will move to page 27, which is page 51 in the combined report. And I'm going to go through just the three different portfolios over the next 3 pages. And as Glenn already mentioned, the portfolio, the most aggressive growth portfolio, was down 17% for the first quarter. It has come up quite a little bit since then. But overall, I would say, even though this is not, the level of performance any of us, love to see, it is exactly what we would expect out of this portfolio in terms of its performance relative to its risk allocation. So this portfolio is about 80% allocated to risky assets, and because of that, it's highly sensitive to what happens in the stock market. And with the big sell-off in the stock market over the quarter, it's not surprising that this portfolio as a whole would be down, 17% when the stock market as a whole is down, 20 to 23%. The next page, the moderate portfolio. Again, this is moving to less risk allocation, roughly a 50-50 allocation between risk and conservative assets. And this portfolio was down essentially 10% for the quarter. So a big difference in returns between the aggressive and moderate portfolio. Again, the performance of the portfolio is exactly what we would expect. It's providing about half the exposure of the stock market. So if the market's down 20%, this one's down 10%. What's nice to see, and we'll see this with the next portfolio as well, is that there's a good differentiation between the exposure of the different portfolios. So a participant that is investing in the aggressive portfolio is truly getting an aggressive portfolio. And as a participant investing in this moderate portfolio is getting a nice moderate return. That's between the aggressive and the conservative performance, which can be found on the next page, which shows the performance of only being down 3%. So a very modest loss when you consider risky assets being down 20 plus %. This portfolio only lost 3%. So definitely provided the risk exposure that participants would think of when they're thinking, okay, I'm going into a conservative portfolio. What does that mean in a big market sell-off? I think a lot of participants would say, okay, I don't expect the return of the portfolio to be up at all time periods, especially if the market's off 20%, but I definitely don't want to be off 17%. I think participants would be real happy with only losing 3%. Obviously, no one likes to lose money, but when you look at the size of the market sell-off, to only be off 3% just kind of shows that this portfolio did exactly what it was kind of designed to do. And again, just kind of echoing back to that point of having three different portfolios truly do differentiate each other in this kind of case study of a market where we can actually see that differentiation with one portfolio, the most aggressive, being off 17%, the most conservative portfolio only losing 3%, and then the moderate portfolio, as you would expect, was kind of in the middle of those two, off 10%. So I only bring this up because I think it shows that the plan is very well structured, and it truly does allow participants to self-identify from a risk standpoint. Because don't forget, there's also the FDIC option, which had a positive return. It was minuscule positive return, but it was still a positive return. So from an investment standpoint, this plan is well structured. It truly does offer participants to self-identify what their risk tolerance is. And this last quarter was truly a good case study of that differentiation, which often, to be honest, doesn't really show up that often. It only really shows up in kind of dramatic market movement. I was going to leave my comments there. There's more pages if there's any questions, but I just want to be cognizant of time and make sure I answer anyone's questions.
Thank you. It's good to hear that although the first quarter is not looking good, the markets have bounced back. We're hoping for better news over the next ensuing quarters. So any other questions from board members? No? All right. Dante, are we on the next one?
If there are questions from the audience.
Okay, public comment, anyone? No? No one on the phone? phone, no one here. All right. Thank you. Thank you both.
So the next item is an information item, and this is one that you should be familiar with. Andrea and her team work on a twice a year basis to provide us with this. So the last time that they had this kind of industry update was 6 months ago. Not a whole lot has changed, but I'll leave Andrea to go over some of the details.
Great, thank you, Dante. Can you hear me, everyone?
Yes, we can.
Great, good afternoon, and thank you for the opportunity to be here today. If you're looking at the combined deck, we're actually starting on page 76 of the PDF. As Dante said, there aren't a lot of changes. I'm going to point out just some very high-level ones, and just give you some specific program changes, and then just talk for a minute about the outlook. So if we come down to page 79 of the deck, there are no changes in available plans. I will note Dante did talk about the activity in Connecticut. I will also tell you that Hawaii is apparent or reportedly close to making a decision. So I would think that by the next meeting, the next time we update you on this information, perhaps we will see 2 more states added, so we should be at 44 states and the District of Columbia, but for right now, no changes. If we go to the next slide, when we were here in December, so this is actually slide 80 of the deck, it's page 5 of our deck. So in December, we gave you the numbers from the third quarter of 2019, which was September 30th of 2019. These numbers, I also have to say, are graciously shared with us from ISS Market Intelligence, and we thank them for that. The interesting thing you can see in today's market, we're at about $381 million across close to 64,000 accounts across the country, with an average account balance of a little bit under $6,000, so the $5,974. What I would tell you that's good to see is that notwithstanding the end of the third quarter, the first quarter of this year, and what you've heard from Glenn and Eric, our total assets under management in the ABLE market have increased about 23%. So notwithstanding the market sell-off in March, we still had 23% growth from when we saw you last September. We also saw accounts grow by about 20%. So I think that's healthy growth. Average account size didn't increase that much, but that doesn't trouble me so much. It only went up about 4%. I think what we always focus on when we talk to boards is what kind of account growth we're seeing, and I think 20% account growth over half a year is a good indicator for the ABLE market. Moving on to the next slide, which would be page 81 of the combined deck. This actually drills down. The numbers I gave you on the prior page were for the whole ABLE market. This page actually drills down to what we call the independent plans. So those are the plans, just like California's, as you remember, that are single state plans, maybe offered nationally, but the assets and accounts and growth within them really rely on just what comes from one state. So what I would tell you on the independent side is that the growth of the independent plans overall was about the same as we saw in the whole market. So the independent plans today account for about $152 million. When we spoke to you last, they were about $115 million. And that's about a little over a 24% increase. Similarly, we saw about a 24% increase in the number of accounts within the individual plans or the independent plans. We were at about 21,000 when we spoke to you in December, reflecting the numbers in September. We're at about 28,000 now. What I do want to point out on this page is California. Kind of in the middle of the deck, you'll see it'll come out because of the yellow highlights across the assets, accounts, and average account size page. And what's really great to see is that on the asset side, today we're at about $17 million, or again, these are the 3/31/2020 numbers. At about $17 million, that represents about 50% growth since last September. So we added about $8.8 million in assets over that 6-month period. Similarly, we saw accounts increase. We had about 1,700 accounts on September 30th, and today we're, as you can see, at about 2,700. We also saw a good increase in the average account size of those accounts in California. An average account size of about $6,400 now, which is higher, I'd point out, than what we see across the entire ABLE market or what we see across the independent plans alone. So that's a 22% increase since we last saw you, or last talked to you. So I think all good growth indicators for the state of California and the CalABLE plan. Turning to our next page, we continue to show you this sort of that timing view of the market where you were the last plan that was launched. And yet what you can see, again, the green representing independent single state plans, you really are bigger than several other large states that have been in the market longer than you. The two I would draw your attention to is New York and Texas, where you're easily, 4 times the size of the Texas plan, notwithstanding the fact that it was out 6 months earlier than you, and twice the size of the New York plan, which really had 2 years on you. So that's what I wanted to point out on that page. This next chart, page 83, it's just really the growth chart, and the only, just to show you growth over time. Sometimes we focus, we hear sort of the less than robust sales. Sometimes you hear it that way. And I think what we try to show you is a quarter over quarter over quarter from the initial issuance back in 2016 for the initial launch of an ABLE plan. This market continues to grow. And that's the message on that page. Moving on to our next page on state tax benefits, I did want to point out that Iowa has added a state tax benefit, and that is so I was going to say I think that's a credit, but it is actually it's a tax deduction. Oregon has actually changed the nature of its offering. It had been a deduction, and it is now a credit. So while the number of states has not changed, while the number of states hasn't changed, no, I take this back. I'm sorry, the number of states has changed since we talked to you last. I just wanted to really point out that, we are seeing more states that are offering some state tax benefits. Moving on to the next page, the other benefit that obviously state plans are looking at is the state treatment of the Medicaid recovery. And what I would tell you here is that we have added the state of Maine to, by state statute, they will accept ABLE assets in their ABLE plan from the Medicaid recovery. I say that I also want to tell you that the Maine ABLE plan has not yet been launched. But I did want to at least point out that another state was taking that action and moving in that direction. So that's the overall market. If we just go down to, I guess it's page 87 of the combined deck, really the program managers and service providers have not changed. We only changed the dates of 2 contracts. That was for Intuition in Ohio and Northstar in Texas. That Northstar contract in Texas is just continuing in an extension mode. I don't have an updated contract date for that or termination date. I will tell you that with respect to Intuition, they are in the process of rebidding their program administrator, and so we're waiting for word on what happens with Intuition servicing the Ohio partnership and their 12 states. Moving on to this next page, just a snapshot. Not much has changed with respect to investment managers. What we continue continue to see the domination across this market by Vanguard, BlackRock, and Schwab. Makes total sense, low cost, passively managed options. I will say that there is some movement and some change in Tennessee, and you'll see this on the next page. It's really interesting so this is page 89 of the combined deck. We've often talked about the importance of simplicity in the investment choices, and you can see that that remains the case here. Tennessee is the one state that has had a predominance of individual investment options, so much more specific asset class choices than you see in the other plans, which are largely dominated by target risk or static options. So just an interesting note that Tennessee eliminated its static income option and its static conservative growth option, and remains today the only static option that they offer today is a balanced portfolio. Moving on, this next page I think is interesting in light of the comments that have been made so far today. This is page 90 of the deck, of the combined deck. So, and I know we'll get to this later, but this really kind of lays some of the groundwork for what we're going to talk about. You know, we're still seeing a third of the market or more gravitating toward cash and cash equivalent options. So we actually, when we were here, or when we spoke to you, or when we looked at the numbers at the end of the fourth quarter of 2019, we had about a little under 32% of the market on assets were in FDIC insured and money market options, and today that's a little over 34%. So continuing to see that trend, if you will, of people putting their money in what is perceived to be a safer investment option. These last pages I'm going to go through very quickly, just really prepaid and debit cards, what we're seeing in the market. I would really just, the only change here is that Florida is now offering a prepaid card, and when we were here last, the Oregon Partners, which is right above Florida, those plans were in suspension, or their card was in suspension. Today, the same provider provides the Oregon Partners and the Florida plan with their cards. Just a snapshot here again, next page, just showing you that Florida has launched an ABLE Visa card issued by the same provider, the bank provider, as the Oregon Partners in the last line. You can go back and look at this when you're bored and don't have anything else to look at or to do. You can see the card-related fees. Once again, Florida, it should have been highlighted. I apologize about that. This is page 93 of the combined deck. Florida is now offering that same card as Oregon. I do think there's a typo, and I should just point that out on Florida. That should have been $1.50 for the monthly account fee, so I apologize. So then, just wrapping up the landscape when we think about the outlook. Since we were here last, I wanted to point out that we have seen some movement on the ABLE Age Adjustment Act. Following the NAST, the National Association of State Treasurers Hill visits in February, where Treasurer Ma and Dante were very visible, the number of co-sponsors for this legislation in the House has increased substantially to 73. I would tell you that the understanding is that the Congressional Budget Office won't even put a score on this until there are probably 100 or more co-sponsors. So it was a significant jump in co-sponsors, but we're not quite at that point we need to be yet. But more importantly, and as you know from reading the paper every day, almost everything is on hold in Washington because of the importance and just real need to be passing the COVID relief and stimulus bills that are taking shape. So that's the first thing with respect to ABLE Age Adjustment. Dante mentioned, some of the working group efforts at the NAST level to work with employers to do some employer outreach. And also there's some discussion about working with consumer financial institutions. One of the banks that has come up is JP Morgan Chase, so it'll be interesting to see. I have the honor of working with Dante on the working groups for both of those. And then just the last thing to note at the employer level, It's a gift card, but it really is a broader reach than that. Gift of Independence now allows for funding CalABLE accounts through the workplace if you work through ADP as a payroll provider. So I think that's an important development. We've talked about the activity at the program level, talked about Connecticut, Ohio, and Hawaii. I would mention that we do think there may, we're watching closely what's happening in the Nebraska ABLE program. It is a small program, but it's a partnership between Nebraska and Alabama. We think that the program management of that will change in the next 6, 8, 10 months. So to Dante's comments about continuing to look for partnership opportunities, that may be one. And then I think Dante already covered short-term contributions from the stimulus payments. You know about the great work that he has done on your behalf with collaborating with NDI. And then we continue as an industry just to look for rules and guidance and some agreement on account management as between representative payees and authorized representatives. And that covers the landscape.
Thank you, Andrea.
Yeah.
Which reminds me, every time we talk about those tax incentives in other states, it always obviously makes me think about what we should or could be doing. And unfortunately, due to COVID-19, we don't probably have any chance of changing that this year, but Genevieve is leading a movement to update the Treasurer's Office under John Chung. He did a really nice kind of a summary of all of our programs and some of the recommendations to the legislature. And so I think creating some sort of incentive plan, a tax credit or a tax deduction so that we can better compete with other states, keep the money here, is going to be one of the recommendations. So at least we can feel good that we're at least continuing to promote the idea even during this downtime. So any other questions, comments?
Madam Chair?
Yes, Gail?
Hi, I just wanted to congratulate Dante and his whole team on the remarkable job he's done to keep membership up and keep the total dollar amount up. It's really remarkable, and I'm incredibly proud of California's program. So thank you for your leadership and to Dante especially.
All right, any members of the public wishing to comment on this item? Okay, seeing none, thank you very much. All right, number 5, COVID-19 impact on ABLE programs. Did we cover that a little bit?
We talked about it a little bit from an operations standpoint, but there is sort of a deeper level conversation that I wanted the board to have the opportunity to engage in. And that is specifically around element, and I really want to thank TIA for their partnership and leadership with this particular issue. And I can say that very early in the beginning of the COVID-19 crisis, Linda and I had a conversation that was related to some of the calls that we had begun to get when we saw the market tanking. We recognized very quickly and early on that we received calls from account holders who were concerned about their portfolios losing money. We were very quick to educate folks about the nature of the marketplace and to point them towards our FDIC insured portfolio when we recognized that there was very little tolerance for risk among ABLE account holders. The concerning thing about the FDIC insured portfolio, especially as it related to this crisis, was when we saw the interest rates hurtling towards zero. And as you're aware, if you're in the market, if you're borrowing money, if you need short-term cash, low interest rates are a great thing. If you're on the other end of that and you're trying to earn a return on an investment, low interest rates are not so good for you. And because our FDIC insured portfolio was designed with the intent of being that safe space, which it has been, but we were acutely aware of the lack of risk tolerance for some of our folks who really, frankly, can't afford to lose any money. And so the board was very prescient and generous to waive the state administrative fees related to that FDIC insured portfolio. And our intent at the time was to make sure that, at least from a fee standpoint, we weren't causing a loss of principal related to folks who chose to park their money there. But as the return on that investment, the interest rate paid, gets lower and lower, we see that unless you have a substantial sum in your account at the current interest rate, we are not even covering the $37 annual account maintenance fee related to that portfolio. And so I'd asked Linda very early on into this to see what alternatives might exist to an FDIC insured portfolio. And after a few weeks, she came back to me with an interesting proposition for an alternative, which was to look at the potential of eliminating the FDIC insured portfolio in favor of the funding agreement, which is based on the TIA life insurance program. It's something that is already an underlying fund that makes up our target risk investment portfolios. It's something that exists in other, our sister board, California Scholarshare 529 program has one of these funding agreements that is one of the portfolios that you can choose. And so that started some research on our end. I think that it was a reasonable solution in that it offered the potential to have a higher floor an interest rate return that would beat the FDIC insured portfolio, and potentially a much higher ceiling of what kind of return it could offer, while still offering a similar level of protection against vast shifts in the market. And so I talked, at that time I looked into these types of options, had conversations with Eric over at Makita, and even some foundational conversations with several board members to get a better understanding of these types of products. And I thought that it would be beneficial to have a larger discussion with the entire board to sort of understand these products, and potentially, if there was enough interest, to chart a path forward to how we would continue to look at this. I'm not proposing at this time any action related to them, but wanted to make certain that you as a board were aware that we are exploring every opportunity, and if you find that there is at least a kernel of interest left, that we would continue to explore this to the full extent that we can. And I really want to thank TIA because they came to us with a proposal of a product that makes some sense. I think that with due diligence in mind and our responsibility as fiduciary to the account holders of CalABLE, that we were to fully explore this, that we may look beyond TIA's initial offer and open up this type of opportunity for a request for proposals that would be led by Nikita within the confines of our current contract with him, so it wouldn't be any additional, it would be additional work, but it wouldn't be at an additional expense that would be completely unanticipated. And at the same time, we could also explore the option of doing nothing, but just knowing that we have an alternative in mind if it is worthwhile to explore. So I thought with that in mind, I would turn things over to Makita to explain the type of product that we would be looking at, and then Andrea to give us some contextual information on who else is looking at this and what the potential upsides and downsides could be to this type of exploration.
Okay, thank you, Dante. So, so the speakers, I kind of don't understand why we are going to move from FDIC to the TIAA funding agreement. Like, what is the real difference, or why are we even looking at this?
So I think that Eric and Andrea can give you a little bit more context on what it is and how they work. What I can say, the potential benefit is, again, going back to that idea of we have a product now that is yielding a very low return, just the last quarter, 0.1%. And so that return, when compared to the annual account maintenance fee alone, because that's all the folks, if you're putting all your money in the FDIC insured portfolio, that's the only fee that you're receiving is that $37 a year. So unless you have a significant amount of money in it, in that portfolio, you're losing money by having a CalABLE account just by opening the account. It's going to cost you $37 a year in fees. And so we recognize that especially that lower end of account holders, folks who have very little disposable income, that the prospect of it being a negative dollar proposition at all could be concerning. And so I asked Linda very early on to take a look to say, are there other products that might yield a higher return? And if there were, then could potentially the board then consider discontinuing the waiver to the state administrative fee that could then propel us further down the line toward self-sustainability. Again, that is sort of a future proposition, but the idea is looking very closely at those folks who say we're concerned about any loss. And so the product that was recommended, again, Andrea and Eric can go into a little bit more detail, but that's how we got to this point.
So $37 fee in the FDIC fund. How much is it for the TIAA funding agreement?
So again, we haven't gotten to a specific, but this is just an opportunity to explore. But in our conversations, we've talked about what is that potential minimum interest, and we're looking at somewhere around 1%. When today we're at 0.3%. So could be considerably higher.
And before we get into the substance of the conversation, I have some opinions around this. But does it have to be an either or could it be both? So an individual, if they felt strongly about the FDIC side and the full faith and credit, that helps a lot of folks sleep at night, they could choose that, and we've seen 36% of our folks have decided to go that route.
Yeah.
If they want to go into a stable fund, and they know they're giving up full faith and credit of the government for pursuing a bit more of interest, that they have that choice, especially given that it's the the single largest fund that we currently have.
Yeah, I think you bring up a very important point that is critical in this discussion, and that is that the public recognizes very strongly the value of that FDIC insurance. It means something, and we have that conversation every time that we are doing outreach about the FDIC insured portfolio. And so that is something that you would potentially be giving up. There is nothing from a legal standpoint that would prevent us from offering an FDIC insured option and a stable value or funding agreement option. But I can say that the structure of these programs, because they perform very similar functions and that they're not directly tied to sort of the ups and downs of the stock market, because they offer a similar value to folks. The structure of these, the rates that you get, the ceiling and the floor that I talked about, are really based on the amount of assets that you have in them. So we may be diluting, when we dilute the potential of folks that would go into those, into a stable value portfolio, we may be in effect lowering the floor and ceiling interest rates that we could offer.
And I think that's a good point. But I also think that we continue, if we have an option, the benefit of a guarantee for folks that helps them sleep at night. And God forbid something horrible happens to the economy.
Right. Okay. Okay. Who's Andrea still on, and Eric?
Yes. So I believe my report is first, and I believe you have a separate handout, and I'll start on page 2. Unfortunately, it will be kind of a page flipping report. I usually try to avoid that, but we'll likely have to flip a lot of pages in this. And that is page 102 of the overall combined board packet. Just as kind of a background, kind of backing up what Dante was saying and kind of the rationale for potentially looking at moving into a stable value from FDIC. Just again, this is something we're exploring, and we just want to provide background to the board. And kind of the reason we got here is with the Fed cutting interest rates to all-time lows, basically setting the federal funds rate at 0%, providing other liquidity measures, that has driven down yields across the board. The yield curve in the United States is extremely low, with interest rates all the way out to 10 years under 1%. So it's a very yield-scarce environment, and because of that, all kind of short-dated, money-sensitive, as Wall Street parlance would call it, interest rates have been essentially reduced close to zero. So if you look at money market funds, those have been slowly readjusting closer to zero, as some of their higher yielding securities have been maturing, and then they're having to reinvest in short-dated securities that currently have about a 0% interest rate. The kind of corollary to that is banks often set their savings account interest rates based on the so-called money interest rates that they see in the market. Because if you think about how banks make money, they make money on spread. So they basically take in deposits at low interest rates and then lend at slightly higher interest rates. And so they don't basically keep those numbers the same. What they try to do is keep the spread the same. So they readjust both rates depending on movements in interest rates. And because of the truly remarkable low interest rate environment we're in, where short-term money is essentially yielding 0%, banks have put their FDIC-insured savings account return rates at pretty much zero as well. So to kind of give you context of this, one way to think about this issue is what we term break-evens. And so if you think about the $37 a year fee that participants pay on FDIC-insured balances, and we're just going to assume that's their only allocation because it gets more complex if they have multiple investments. But if you think about an investor with only FDIC assets, that $37 a year fee, they need a balance currently about $10,000 to break even. So to earn any kind of return, they need over $10,000 in account balances. Anything under $10,000, they're seeing their account actually go down in value quarter by quarter or month by month. And as interest rates will likely continue to go down, so right now, if you look at where the FDIC account is within the program, and you compare that to kind of national averages, I wouldn't be surprised to see that interest rate actually go down from here. Now, I don't know if Tia has any better insight on that, but just looking at national averages, it seems a bit high compared to where the market is. And if you kind of adjust that interest rate down to kind of national averages, the break-even balance gets dramatically higher very quick. And you could have break-evens in a very realistic scenario over $35,000. So almost every participant would have to lose money with investing only in the FDIC option. And so there's kind of this oxymoronic situation, or this perverse situation, we should call it, because they are investing in the option with the intent of not losing any money, and they're essentially investing in, but in reality, they're investing in the only option that guarantees they lose money. So there's this really tough dynamic currently playing out there. And so that's where the idea of stable value as an alternative comes from. So stable value, we currently have that within the program already. So the moderate and conservative risk allocations actually use allocations to TIA's funding agreement, which is a stable value product within those portfolios. So that stable value product currently yields 1.75%. So that rate, let's be honest, will likely kind of tick down if we don't see a rebound in interest rates over time, yet it's guaranteed for certain time periods. So that's going to be a key feature of this, is that interest rate is guaranteed for, let's call it, the rest of 2020. And so the plan will do really well holding that investment relative to what they'll earn in just the general market. Because if you think about the entire yield curve of the United States, all the way past 10 years is yielding under 1%. So that 1.75% is very compelling. And that would, if you think about going back to break-evens, that makes the break-even fall, closer to $2,000, which is much more in line with where balances actually are. So to get into kind of the discussion of stable value themselves in terms of what are they, they're really insurance contracts. And so they come in different flavors, which we'll get to on the next page. But the whole idea is to provide an interest rate that is materially higher than money market or savings account returns that still has a guaranteed preservation of principal. So what that means is that they will never see the balance change. Everything is held at $1 NAV. So it's just like having a savings account in that the principal never changes, but the interest rate is considerably higher. Now, these type of stable value products are actually only available in defined contribution plans, which is unfortunate. It would be nice to just keep our savings in one of those individuals, but it's not available that way. It has to be through a defined contribution plan. So moving on to page 103 in the combined below page 3 of our report, there's really 3 different types of stable value products. You have what is termed the traditional guaranteed investment contract. If you look at the history of the development of stable value products, this was kind of the first one that you rolled out, and that's why it's called the traditional one. And what it is really one single insurance company basically writing a contract where they guarantee a certain interest rate for a certain period of time, and then will guarantee that with the full faith and credit of that insurance company for the plan. So if you look at the funding agreement for the rest of the program, we're guaranteed 1.75 for the rest of 2020. That's written into the agreement of the contract. And then other terms are listed as well in terms of, when does the rate reset, what's the maximum reset rate, what's the floor of the interest rate, things along those lines. It's all just written out as a contract. It's not based on market movement directly. Now, there's still indirect influences from changes in interest rates that get built into it, but it is truly just an insurance contract written between the plan and the insurance company. And so it's always guaranteed to have that stable $1 NAV. So your account balance will never change in terms of market fluctuation. So that's the traditional guaranteed contract. There's other options. There's called the separate account GIC. It's similar to the traditional GIC, but the assets are held in a separate account. There's theoretically some greater protection in the event of the insurance company's default. That's debatable. But you tend to see fewer of these. These tend to be set up with large plans that have more defined features associated with them. So we shouldn't really spend too much time looking at that. That's probably not one of the most appealing options to us, or where there'd be a lot of market interest in providing that to us. The third option is what's known as a synthetic GIC. And the way this works is you actually have a fixed income portfolio manager who buys intermediate term bonds, so bonds of, I call it 5 to 7 year maturity in both government backs and treasuries, but also corporate bonds, and basically runs kind of a lower duration, mid duration, core fixed income account. And then they buy what's known as insurance wrappers from one or multiple, usually multiple insurance companies that then guarantee the NAV. So the insurance company will actually ensure that at any time the participants can transact at $1 NAV, whereas the portfolio will move up and down based on market interest rates, but that will all be behind the scenes hidden from the participants. All the participant will see is that $1 NAV. But the cost to the insurance company to actually provide that wrapper does bring down the returns of the overall portfolio. So if you think about a kind of 5 to 7 year portfolio right now, you can construct one with a yield of 75 basis points to 1%, but then you're going to have insurance contracts that cost money on top of that. So you'll see almost half that return kind of given away to the insurance companies for that NAV protection. That being said, you're still getting a market interest rate that is probably twice to multiples of what you can earn in money market funds, and significantly higher, probably 10 times what you can earn in a FDIC product. I will go by the next page. I touched on it. That's there for your reference if you want it. The next page is historical performance. This kind of gives you a sense of the return structure of stable value. And what you can see is stable value returns tend to be kind of between short and intermediate term bonds. So investment grade bonds is how we term it here, which makes sense because that's pretty much where in the yield curve that they're building their portfolios is kind of in that 5 to 7 year intermediate segment of the yield curve, and they're buying both treasuries and corporate securities, so securitized securities. And then you have to subtract, of course, the cost of the insurance for synthetic GICs, and then that's essentially the return that the insurance company is making on their general account, which is based on market rates. So both traditional and synthetic GICs perform about the same over time, and you can see that with the returns of stable value when you compare that to cash, which is what money market funds do. Remember, money market funds tend to be a little bit more higher yielding than FDIC products, so we don't have FDIC on here, but you would basically subtract a little bit from cash to come up with that return. So when you compare stable value to cash, it's quite compelling, especially over the last 10 years. You see a return for stable value of 2.5% versus only 0.4% for cash. So quite a wide spread over the last 10 years. So what are the primary risks of stable value? And there's really two big risks, or call it three big risks. The big risk that a lot of people kind of focus on is actually the second one listed, which is the guarantee provider default. And so if you have a traditional GIC, you're basically dealing just with one insurance company. For the ones within the program, it's TIA Crest Insurance Company. And because of that, the financial well-being of that entity is kind of paramount to your guarantee. And so if theoretically that company runs into massive losses and has to essentially disband, default on their portfolio, basically the company goes into bankruptcy, you're exposed to that risk. There's risk to your contract being broken because of that, and then you would be theoretically in line with other creditors on their assets. So they would still have the assets within the general account, which is where insurance companies pool their assets. So you'd still have a claim on those assets, but theoretically you could break that $1 NAV. Historically, this has not really been a risk with any of the major insurance companies because they've been very high quality, they've been very stable, they've weathered basically all the big storms relatively well, and even in the case of default, there are some state backing. I'm not 100% sure on California's backing, but there tends to be some kind of state recourse that does benefit the GIC and in terms of providing some stability. And that process, though, could take substantial time. So that's that last bullet under the second major bullet. The other risk that gets a lot of attention is interest rate risk. And we, in this part, term it negative slope interest rates, but really that's a pretty rare phenomenon. And we would still earn a positive return, just not as high. And what that would mean is ultra short-term interest rates, call it 3-month securities or securities that are 1 month and shorter, actually yield more than securities that are 5 years out. Normally there's a positive slope to interest rates so that the longer you go out on the yield curve, so the longer until maturity, you earn a higher rate of return. In very rare instances, there's an inverted yield curve where the situation might occur that money market funds can actually out-yield traditional stable value products. This is extremely rare, but it's there. The other time you have to be concerned about is when interest rates adjust very quickly, because if interest rates go up very quickly, money market funds who have an average maturity of like 120 days, which means their securities are resetting, they're buying new securities. Securities mature every kind of like 90 days to 120 days, somewhere in there. They reset much quicker when interest rates are going up. The securities within kind of both a traditional and a synthetic GIG are much slower in resetting because you have an average allocation of about, call it 5 years. Then the last risk I'd really focus on is liquidity risk. It's different in terms of what we traditionally think of liquidity risk, or it would be you suffer losses if you have to sell in the market or the market's down. It's not that. It's if we want to restructure the program, so if we want to move away from one gig provider to another, it can often take a year or more to actually be able to move those assets from one provider to the next. Normally, they only allow a rolling process where you might be able to take 20% per quarter or something like that to move over to a new gig provider. So it's a risk, but it's a risk that doesn't come up much because it only really arises when you're moving from one provider to another. There is no liquidity risk to the participant, to the end participant. They have daily liquidity at $1 NAV. Then the kind of last two risks that are kind of higher level, but they are still risks, is transparency. There's less transparency to what is happening within that contract versus a money market fund. And a money market fund, the investor can pull up what the securities are, what the interest rate is at any given time, have much higher, see-through of what's actually happening. In both a traditional and a synthetic gig, there's much less transparency. For example, with the funding agreement that we have, the stable value product currently within the portfolio, we only get snapshots of the portfolio on a quarterly basis, and it is looking at the entire general account allocation. We don't have, our specific portfolio within that. We're just part of the whole general account, which is, billions and billions of dollars. And so there's, less visibility. We don't have our own segment of the portfolio. We don't have a traditional portfolio. We're part of this insurance contract. So there's just less visibility from an end participant standpoint. Kind of similar, but not quite the same with synthetic gigs. The other thing that's not transparent is the fees. As traditional general account gig, there is usually not actually even a stated fee on the account. It's normally, or often I should say, a zero fee product. And in reality, the way the insurance company makes money is actually on a spread basis. So similar to banks, they write contracts and then they build that guarantee a certain interest rate, and then they basically build a portfolio within their general account that yields a spread over that guaranteed rate. So, they might be looking to invest the money at 2% and then guarantee to the plan to pay 1.75%. They then take the risk of, individual security defaults and other risks, but they're looking to make money on that spread. But what they actually make in terms of that spread is never disclosed to participants. It's not disclosed to anyone. And then there's other smaller risks. For example, if for small, medium-sized plan, if the record keeping keeper is also the gig provider. Sometimes they provide reduced record keeping costs to the plan for having the gig at the record keeper. That creates potential conflicts of interest. It creates hidden fees, stuff like that. And then also large participants within the plan theoretically pay a disproportionate expense of the plan, a disproportionate share of the plan's expense. So, just moving on to the last slide, page 8 of the presentation, 108 of the overall booklet, just summary. Stable value, think of it as an insurance contract that provides a much higher return, significantly higher return than either a money market or FDIC insured account. But your primary risk, though, is the solvency of the insurance provider. With traditional GIC, you're really just dealing with one insurance provider. That's what we have within the program already. Within a synthetic GIC, you are potentially exposed to 1 to 3, maybe even 5 insurance providers. That spreads the risk around some, but it increases the cost substantially because each one of the insurance providers has to be, paid. So that reduces every insurance company you add to that reduces the return of the portfolio. And so, kind of last few thoughts are, we already have exposure to funding agreements or stable value within the program through the TIA funding agreement. Kind of our views on that is TIA is a top tier stable value provider. We've done well having that portfolio or that contract within the plan. And we would theoretically be supportive of moving from FDIC to stable value. From an purely investment standpoint, we believe it makes a lot of sense because we view the risk to the end participants being exceedingly low. Now, it can never be zero like it is with the FDIC product, but that being said, when you compare the interest rates, the very small incremental risk that the participant is taking is the return for taking that risk. The return for taking that risk is huge when you compare other options in terms of incremental return per unit of risk. So it's one of those very few areas in finance where you get a very high return for a very small amount of increase of risk. And kind of last few thoughts are, currently the plan isn't that large, so we might run into issues. We're not sure with doing an RFP. Since we'd be running it, we wanted to kind of disclose that up front, just given the size of the plan. There's the potential that the economics aren't overly appealing to the wide swath of gig providers. So we're not sure what the interest would be, but we'd be happy to lead that search going forward.
Okay, Eric.
Are there any questions?
Yeah, a couple of us have to take a bathroom break. We have to take a bio break. I see that Andrea has slides. Andrea, that you want to go through. I was going to try to, it's too much, so we need to take a break. Can we just take a 5-minute break and then we'll be back? money, it's actually costing a lot more, so it's gonna take a while to, pivot or convince people to go to a new account, or if we decide, then we'll just roll it? What's the?
Due diligence on a potential alternative.
Okay.
Is really.
Okay.
And I've already let Andrea know that we speak of her.
Okay, good. Sorry. My attention span is not very long. Unless Genevieve wants to come chair?
I have confidence in Andrea. Are you ready? Are you ready?
Yes, okay. Thank you for accommodating us. All right, anyone have any questions for Eric? Is this an action item or
Information.
information?
Information.
Eric, this is John Doyle with Developmental Services. A quick question on the wrap contract that you explained in the synthetic gigs. Could you provide a little more detail on sort of how that works and how it provides that guarantee on principal value?
Yes, thank you. That's a very good question, and I will be honest, I got glossed over that just in the interest of time. And so the way it works is there's actually two parties to that. You would basically hire an investment manager. It could be TIA, it could be a different investment manager, really any investment manager, fixed income focused manager, I should say. And they build a customized portfolio of intermediate term bonds. So think about bonds that are 5 to 7 years to maturity, both government backed, so treasuries, core fixed income focus, so corporate, securitized, so mortgages, other securitized debt. And they just manage that portfolio as efficiently as they can. And then you go out to the market, the provider goes out to market and looks for different insurance companies, and they normally try to target 2 to 3, so more than just one insurance company, to try to limit that, what is termed idiosyncratic risk, so the risk of one insurance provider going bankrupt. So they try to have multiple insurance companies aligned to it. And then those insurance companies, what they do is they basically write insurance contracts that guarantee the $1 NAV transactional ability for that portfolio over a certain length of time. So that could be for 1 year, it could be for 3 years. And they based their contract, so how much it costs, based on kind of the riskiness of the underlying portfolio, how comfortable they built that underlying portfolio, and then kind of just market rates. And so that insurance cost is normally about 20 basis points. It might be a little bit higher for a smaller mandate like us, so maybe think 25 basis points, so a quarter of 1%. And what that insurance contract does is it allows for market fluctuations to essentially be eliminated from consideration. And so the insurance providers are basically there to offset any changes in interest rates. And the way that actually happens is kind of true ups at the end of the insurance contract and along the way where any market value losses or gains are netted out against each other over time. And then the insurance provider potentially has to actually provide money, provide capital to offset any of those losses. So the insurance company is there basically insuring against dramatic movements in interest rates and defaults from the underlying portfolio. Some of them actually don't guarantee against defaults, so they can get kind of highly technical when you get down into the weeds. which is one of the reasons I kind of glossed over it. It's one of those situations where if that's the direction we're going to go, we'll probably do a much longer discussion about kind of the details of how it actually functions. But from a high level, the way to kind of think about it is a core fixed income portfolio with an insurance company or truly multiple insurance companies guaranteeing to the participant that they don't have to actually see any changes in NAV that come about by changes in interest rates or defaults. That's kind of the high level way to think about it. But to provide that guarantee, you do have to pay them a spread. And so you end up paying two people. You pay for the underlying investment manager, which is normally called 25 basis points, and then you pay again for the insurance contract another 25 basis points. So it's called 50 basis points in cost. And so your portfolio, the return of the portfolio is the yield on that intermediate term portfolio, call it 1%, minus the two costs, the investment manager and then the insurance cost, I'll call it 50 basis points. So you still get an all-in interest rate of call it 50 basis points. But it's really dependent on what that portfolio is yielding at the start.
Okay, thank you. That's helpful.
David?
Yeah, Eric, I have a question. Today, the Congressional Budget Office came out and said projects GDP dropping by 38%, 26 million Americans out of work, an additional $2.2 trillion to the deficit. Given those financial conditions, something we have not historically seen, to me, that puts a lot more value on the full faith and credit of the United States government versus that of an individual company. And to me, kind of putting on our fiduciary hat, it seems the change that we end up taking as a board is now we're taking on the risk by assuming that everything will be okay, rather than the participant taking on the risk when they make a decision to take an FDIC product that we all have in our normal banking endeavors. But then we also make decisions on investment. And the fund provides a conservative, medium, and aggressive portfolio that, as I understand, you can split your funds into, so that if you wanted to try to reach for a little bit more interest, even in our conservative portfolio, and we saw that it only took a 3.3% hit in the worst economic calamity that we've seen in a long time, then it seems to me there are options that a participant could avail themselves of to continue to chase growth in their principal or principal protection, other than taking on, if this is an either or, a stable value fund where the guarantee is to the insurance company. And I understand there's a slight risk, but there was also a slight risk of Bear Stearns going under as well. I mean, we've seen this in our lifetime. We have historic uncertainty, and we're talking about the idea of moving away from an FDIC full faith and credit when we have an economic situation that we don't know is going to conclude. I would agree. I think that the likelihood is that everything is going to turn out okay. But as a fiduciary, I mean, I can't guarantee that. The only thing I can guarantee is if there's an FDIC product that the principal up to $100,000 will be guaranteed.
I think you're obviously, very well versed in, and I can't disagree with what you're saying.
Elena?
Well, I don't think I could have expressed it any better than Mr. Oppenheimer over to my left. I just wanted to note for the record that we've seen an increase, certainly in the number of people exercising the FDIC portfolio. It was 33% in the last quarter, if I recall correctly, and now it's up by 3%. So I think people are expecting security, and security that can only be provided by the federal government at this point in time, particularly in this time of COVID-19. But I wanted to kind of, ask the question on the flip side. It's a logistical question. Let's assume that we decide to move forward with them. We release an RFP. When are we looking at this going into effect? Knowing that if we're talking about January 1 of next year, a lot can happen between now and then, and we may, be indulging in this particular exercise for very little return. So I just wanted to get a sense of that.
Yeah. I haven't fully explored sort of the extent of an RFP, just understanding our contractual processes. It could be, 3 to 6 months before we would be ready with a new product. But again, I think Linda wanted to have about 10 seconds to convey some information as well. Is this the right time, Linda?
Sure. Yeah, anytime.
Yeah.
Hi, Treasurer, board members. Glad to be here this afternoon and really happy to be having this kind of conversation around program structure and how best to move forward and help our participants with their savings goal. And I really just wanted to take a second to say, we came to Dante with this recommendation really as a way to problem solve. We have tools in our toolbox that we're not using here in the funding agreement, and we thought it was really something for the board to consider that could make a big impact, right? Obviously, Eric has gone through some of the risks. However, there is an upside potential for the participants, and the board, could also institute its fee that you're currently foregoing on 36% of the program. But in the end of the day, whatever the board decides, we're able to accommodate. If the decision is to stick with the FDIC portfolio, that's fine. If you want to go to RFP and find a stable value product, we can accommodate that. Or if you decide to move everything into the funding agreement, we can also accommodate that. So I know there's a lot of discussion and a lot of decisions need to be made, but I wanted you to know, from our perspective, we're able to accommodate what the board, might decide to do, and that's it.
So,
I was just going to say, I think that it's important to know that no decision needs to be made right now, and I'm not asking that a decision be made.
So I would recommend that you go and meet with the board members and see what their appetite is for this before we, spend more time and effort on this idea. If board members are feeling like FDIC is a good option, there's people that obviously have chosen this option, they do it because it's safe. But if folks feel like we need to explore, because I do agree with David that there are ways for folks to diversify their portfolio if they want to make a little more money, take money out of the FDIC money, their account, put it into other, maybe higher yielding accounts. So to just create another account, just to create another account, maybe is not something that the board members, from what I'm sensing just here with my fellow board members here, I haven't even ask the other board members on the phone what they're thinking, but if you guys want to chime in, now would be good.
This is Jacqueline speaking with the State Independent Living Council. Can you hear me?
Yes, we can.
Yeah.
Okay. This has been a very wonderful discussion. As a CalABLE account holder, I believe the majority of people, they want the lowest possible cost with the highest return on investment. And so sometimes it's difficult to find that, but I am open to, if there's possible for people to have options with FDIC and the other, or as Dante looks into offerings, what would be best for our constituency. That's all I have to say.
Thank you. Yeah, Elena?
I wanted to go back to a comment that was made earlier about, we do move forward to explore this, offer you a choice, and not necessarily eliminating the FDIC portfolio in exchange for there's a choice, appreciating that it may dilute the potential benefit of the other portfolio. But if it's still a return could be seen, then that gives folks a choice.
Yeah. The one thing that I don't want to do, and I understand sort of where we are from a patience and a time perspective, I don't want to exclude Andrea completely from this conversation, so maybe her presentation isn't necessary, but would love just to hear from her for very briefly.
Great, thank you, Don.
I'm sorry. Am I skipping over something?
I think it's important that, and I think we can't lose sight of the fact that we're still very early in the growth of the CalABLE program, and we need to keep that in the forefront of our minds as we make decisions as fiduciaries, because we want to maintain that growth, that steady growth.
Absolutely.
Okay, Andrea?
Yeah, thanks. I'll be quick because I think that everything has really been covered. It's clear from the discussion that I think one of your first questions was whether other products might yield a higher return, which would then, enable us to charge the 44 basis points, which has important implications, obviously, for your ability to repay the state. So I think Eric has laid that out for you. There was a question, I think, about whether it was possible to offer two options, the FDIC and stable value. So I wanted to just give you a little perspective on that. I do want to say one thing about this, because I just want you to understand the position of this product, if you will, in the market. So if we look at, I'm going to be very quick, I promise. If we look at page 4 of my deck, which is page 112 of the PDF, what I want you to understand is that there is not another stable plan that offers a stable value product. That's not good, that's not bad, it's just a statement. So I wanted you to know that. And where we do see the presence of stable value in a large way, though, is in the 529 market. And so I'm going to jump to one other page here. This is page 6. It's 114 and 24 of the PDF. So I want you to, the green bars represent stable value. And what I think you should understand is that direct sold plans, that's the kind of plan we have here in ABLE. It's offered directly to the participant. We don't have any professional financial advisors selling it. That's those first 3 bars that you see in this bar chart. Those are the direct plans. And, 30 direct plans offer stable value as compared to 22 or 25 offering FDIC products, or 25 represents the money market that Eric had mentioned. So I think it's important to understand that, in the direct sold market in 529, of these capital preservation options we see, 40% are stable value. So I wanted you to feel comfortable that we do see this, they are prevalent in the 529 market. I'm going to skip the next page. The last question I think somebody asked, if you go to page 8 of my deck, which is slide 116 of 124, again, one of the very first questions someone asked was whether you could have 2 products. And I wanted to show you that there are 10 529 plans that offer both an FDIC-insured account and a stable value. And that is the most common combination. We see 9 plans that offer FDIC and money markets, but we're not talking about money markets here. The 2 extremes we're talking about are stable value and FDIC. So I want to say that nothing precludes you from offering both, but I would note two things. Offering both may lead to some investor confusion. You know, remember what I said about simplicity of the investment options. I think it might be hard to ascertain that difference. It just takes more effort to think about the difference between stable value and FDIC. I will also say, as Treasurer Mine, you referenced, moving from one investment option to another where you might get a better yield. Very often, when you have two fixed income or two similar options, like a FDIC and a stable value would be deemed to be, very often there are limits on your ability to move from one straight to the other because there's a perceived arbitrage gain. So we have some plans interpose what's called an equity wash. So you can't just go from the stable value plan to FDIC and back. So I just wanted to be clear about that. I don't know, I can't represent to you how it works in the direct plans that offer both that you're seeing on this page 8 or page 116, but I just did want to mention that there are some limits to the ability to do that. So bottom line, nothing precludes you from offering both other than when you think about your constituents and those investors you have served so well, and to the point Jacqueline made, I think about 36% of your investors moving to FDIC. I mean, I think you have to think about whether having two plans or two options doesn't just result in a little bit of confusion. So my points really are that I want you to feel comfortable that while you'd be pushing the envelope a little bit or breaking some new ground in the ABLE market, because we don't have a presence of stable values, it is in fact a well-accepted investment, right, within other similarly structured state-run investment programs, not least of which is your sister program in Scholar Share. But I do want to make one point. This is just the last point I want to make, because Eric referred to it, I think Linda has, Dante has. When Eric talked about the fiduciary risk, he said that was a very limited risk, and I agree with that. I also agree that CIAA is a top-tier stable value provider, no question whatsoever. What I want you to think about as a board and from a fiduciary standpoint, though, is if you move without looking at the market, because of Tia's relationship as your program manager, I think you have to feel even more confident that's your best choice. I think it ultimately is. I agree with Eric also. It is unclear what the market interest would be given the small size of this account today. But just the same, that doesn't stop you from a fiduciary perspective to at least ask the question. So what that really does mean is at least checking with other stable value providers. Should you make that decision to go down the path, and it is knowing the quality of Tia's life funding agreement, knowing its performance, all of those things would say to you, this is a wonderful choice. But I also look at you as fiduciaries, and you just have to be able to say, we checked the box. We checked the box and we saw what else is out there. This is the option that serves our investors the best. This is the option in their best interest. So that's the only point, and I know I don't mean to catch Dante by surprise when I throw that out, but just listening to this conversation, I really feel like I had to make that point for you. So I'll stop talking since it's 6 minutes after 4 in California. Any questions?
Yeah, Andrea, this is Dave. The other two 529 programs you talked about, we have Cal Savers and then we have the College Saving Program. Mm-hmm. Those seem to have different purposes when we talk about then having an FDIC banking option for folks who are truly using it as a banking option, and they use it because they're able to guard their money in a strategic way. They're not necessarily looking for principal accumulation, though we do offer those options. There's a purpose that I think is a little bit different, that we offer an FDIC option, for just that traditional banking purpose, and the ability to bank similarly that you would do your ordinary banking with an FDIC insured institution. And I would also add that I'm having a hard time getting from here to there to get an additional 1%, given so much market uncertainty and given the desirability of having that as a market product. So I just wanted to see if you agreed that the 529 purposes that are permitted, are they indeed similar, or do you understand that there appears to be a difference from the CalABLE perspective?
Well, it's interesting that you say that. I wasn't really been focused on it, but we believe people choose the FDIC account really because they want to use it for transactional purposes more than the fact that they're seeking protection of their principal. Now, a good portion of them may be seeking protection of their principal, but the real beauty, I think, of the FDIC account for an able investor is that you can just take the money out, and you're at very little risk because you are using it for some repeated, frequent, needs. So that's different from the 529 investor who's saving for the long term. Now, when they choose the funding agreement, maybe they're moving into the funding agreement, in the last 2 years before their kid goes to college, and they're really trying to protect that principal to avoid what just happened, right? So I think that really is an attempt to preserve capital here. I can't say to you that that 100% of the people in this FDIC option are doing it because they're trying to save their capital. The truth is, if they're saving for the long term, they could be saving in the conservative static option instead, which has the funding agreement as part of asset allocation. So I think you hit on an important point, and I think you have to discern, are the 36% of our investors who put their money, or the 36% of our assets that are in the FDIC, are these really people saving for the long term? Or are they using it so that money can just come out as it's needed, transactional? The other point you mentioned, CalSavers. CalSavers, interestingly enough, does not have an FDIC insured option or a stable value option. First, we're precluded from offering stable value in an IRA, which ultimately that's that product. But actually, the quote-unquote principal protection mechanism in CalSavers is a money market fund. And that's a fund that gets the first $1,000. If you don't make an investment action, your first $1,000 goes into that money market fund, capital preservation fund, if you will. So before we put you at risk and put you into a target date fund that again is a long-term retirement play. But we're not using stable value there, we're using money market. So, or I should say we're not using an FDIC account there, we're using money market. Because we are looking for the extra principal, the extra return, and because we are trying to get people, it's the first step to people saving for the long term. By the way we structured it. I hope I didn't lose you on that. I just.
No, thank you.
This is Eric White. Can I interject something real quick too? Because I don't know if I was clear in my presentation, so I just want to correct what could have been a shortcoming of my presentation, which is that from a participant, the stable value standalone option would appear like a checking account, just with a much higher interest rate. So it would have that. That's what that, when I say stable NAV, would mean is it would be functionally like a checking account, savings account for participants. That's what it would appear like from a participant standpoint, just with a much higher interest rate attached to it. And then one other little tidbit that I had not seen, and I should have seen it when I was looking at Andrea's deck earlier, is she appears to have the most recent, as of May 1st, annual percentage yield on the FDIC insured product, which is now down to just 3 basis points. I was quoting older figures that were much higher, and that would put the break even at actually well over $100,000 in account balance. So I think that's important to remember is these savers with the FDIC only option will, every single one of them now, because I don't believe there's any participant that could even have an account balance that high, will see a negative effective return on their account every single month.
Thank you, Eric. This is Genevieve, the treasurer, and I just did a switcheroo. So thank you for, for the board members and those listening on the phone, for your patience on this presentation when, Dante brought this up to me. Exactly what Andrea had said is, as fiduciaries, we need to explore what the options are, especially during this current time of uncertainty. And so I think that it's important that we do our due diligence, right? So that way we are properly informed and educated. So when the time comes, we're ready to go to make a decision rather than being reactionary to the market. That's something that I learned during this whole process. As you guys know, the treasurer's office, and David, I'm sure you're aware too, at the controller's office, everything is fluid. And so when we get an opportunity to get ahead and to explore and to educate ourselves, then we're probably prepared for that moment when we have to make a decision. So I appreciate, Eric, Makita, and Andrea at AKF, and even Linda at TIA and the whole team there, and also Dante and your team, and putting this presentation together. It's very technical, it's very complicated, but again, it properly prepares us for when we do have to make, if and when we do have to make a decision. And I think that is, a great and an important role that we take very seriously as fiduciaries, as members of this board. So with that, is there any questions from the board?
Yes, this is Sandra with the State Council. I understand what this means in terms of when the markets are down. What does it mean for our investors when the markets are stable or rising?
So this is Eric. It's important to note that often when I colloquially decide or describe the market, I mean the stock market. These are fixed income products, so they're tied to the fixed income market. So with a stable value or FDIC product, they're both guaranteeing interest rates. The FDIC product obviously can, that interest rate floats much more freely based on where interest rates are, whereas GIG products like the funding agreement have longer term structures, so they guarantee a certain interest rate usually for 6 months or a year or even longer time period, and then it resets every, call it, year. And so in a rising stock market, falling stock market, there is really no impact on these portfolios. They still provide the exact same interest rate that they've stated to provide. In a falling interest rate environment, the FDIC product will readjust much lower, much faster. So your return goes down much faster because of that. The funding agreement, the GIG product, that's much slower because they only readjust, usually called once a year. So that adjustment down to lower interest rates is much less frequent, and often these contracts have a floor interest rate built into it. So no matter what happens with interest rates, they will guarantee at least a 1% funding. So interest rates could theoretically go negative, and they would still guarantee a 1% interest on that account. That's one of the real benefits of that type of account. The one area where an FDIC product theoretically could outperform GIG product, the funding agreement, is in a fast rising interest rate environment. So if interest rates went, 5 to 10% higher, in over a very short time period, say, 6 months to a year, really unheard of, but it's theoretically possible. Because of that delay in resetting, the funding agreement theoretically could lag the FDIC product, which would reset much quicker. That can reset at any time. So that's much faster at adjusting it. But almost in no circumstances does the FDIC ever really out-yield the funding agreement. It's just that situation's just so unlikely that it almost never comes up.
Thank you. Anything else from the board? Anything from those in the room? Anything on the phone for participants? Susan? And so I understand this is the last item. Okay. So I just want to say thank you for the board members for being here in person and those on the phone. I also want to give a shout out to our legal team, Ravi, who's here, and also IT, Greg of IT, for allowing us to stream our meeting live. It's a pleasure to see all of you in person and to hear your voices, those on the phone. So with that, we're adjourned.
I'm at the risk of losing my job. We have a public comment, right? It's not on the agenda.
Oh, I'm sorry. Thank you. So outside of the agenda, any public comment from the phone, Susan? Nothing? Anybody in person? Thank you, Ravi. Thank you, everybody. Good to hear and see everybody.
Thank you, Julie.
You're welcome.
Thank you.